Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have John Devine, Execution Specialist at BlockFills, as well as Alan Orwick, co-founder of Quai Network. We're here to discuss why 2025 could be the year for scaling transparency and deeper market integration of decentralized exchanges. The DeFi landscape underwent a significant transformation in 2024, marking a year of convergence between decentralized and traditional finance. BlackRock Fidelity ventured into decentralized staking, while decentralized exchanges known as DEX gained traction as essential hubs for liquidity and innovation. It is great to have the both of you with us. Let's kick it off with you, John. Give us a brief introduction, a reminder of where BlockFills is within the ecosystem.
Yeah, sure. Great to be back with you, Jill. So BlockFills, we're an institutional liquidity provider and market maker. So we're serving exchanges, and we're also serving the participants directly, like proprietary traders, hedge funds, Bitcoin mining companies. And now more and more, we're starting to have conversations and looking to integrate with different decentralized exchanges.
All right. And Alan, give us some background.
Yeah, hi, Jill. Thank you for having me on. My name is Alan Orwick. I'm the co-founder of Quai Network. Quai is a scalable and programmable layer 1 blockchain, and we have a live network that is operating across the globe. So you can think of it being the decentralization of Bitcoin, speed of Solana, and programmability of Ethereum, looking to bring the next billion users on-chain and actually plug in to these decentralized technologies and have something that can scale to global adoption here. So excited to jump into the topic of liquidity and DEX profiles.
And Alan, before we get into Outlook with you and John, give us a high-level overview of DEX's decentralized exchanges. How are they like and how are they unlike central exchanges?
Yeah, so a decentralized exchange runs on a blockchain. So when you think of how the actual user can come in and interact, they're not interacting with a central intermediary, they're interacting with the network as a whole or a smart contract. So the smart contract can operate and facilitate the exchange of these assets in a trustless manner. So just as Bitcoin revolutionized having a monetary system that has no central intermediary or no owner of the entire network or ecosystem, the DEX or the decentralized exchange has no central authority over that facilitation or trade of those assets on a blockchain. So some of the largest ones that we've seen are like Uniswap, PancakeSwap, and newer exchanges or perp exchanges such as Hyperliquid that are facilitating these trading operations.
What are the benefits to decentralized exchanges, John?
This is going to be the fascinating question. I mean, right now, the low-hanging fruit benefit to a decentralized exchange is it allows access to liquidity and liquidity pools, and you don't necessarily have to go through the hoops that you have to go through to face a centralized exchange. And what I mean by that is onboarding processes and traditional mechanisms that are KYC policies and procedures. Those don't really come into play with decentralized exchanges. That's the low-hanging fruit. Of course, we're anticipating that the benefits won't just stop there. You're also talking about different ways to look at counterparty risk, as opposed to facing off with a centralized entity where you're facing against a balance sheet. With a decentralized exchange, you're facing it off against code, and the risk becomes code risk. And that's another way to think about maybe some advantages that are going to come into play.
Yeah, and Alan, I see you're shaking your head, but we do have to address the concerns when it comes to transparency and potential downsides. What is some of the pushback that you're getting? Because I hear no KYC, nothing central governing this, and I can understand, the obvious apprehension of institutions wanting to get involved. What are these downsides, and how is it being addressed?
Yeah, I mean, from my side, the way I see the downsides with the centralized exchanges, looking at moving into a DEX type architecture, is that, again, they lose a lot of control of their operations. So as we were saying with John's point, these are permissionless systems. So you don't really have an input of KYC. You don't have a way of censoring or limiting the ways in which people operate with these order books. And you have these systems that run 24/7. That's another big benefit, is that there's no sort of on and off time. You can go and interact with a decentralized exchange at any point, at any time of the day, holiday or not, or 9 to 5 or not. So I think whenever you're looking at some of the downsides of people moving into this DEX style architecture, it's how do we move away from this traditional world, this traditional finance, into something that is more open, more permissionlessness, permissionless or more permissionless and has this way of achieving and getting that next level of legitimacy. Because I do think there is a lot of skepticism and a lot of speculation around how DEXs work. And I think it's going to take a lot of time to ensure that these operate in a way that is transparent, because that is what's going to reassure all of the customers and people using DEXs as they trade these assets on a blockchain.
And John, you can understand why a TradFi institution or asset manager would have some pushback. I mean, they are in a heavily regulated space, right? So whether it's developing regulatory framework around that or finding solutions to be able to adhere and comply with regulations, I would imagine that's going to be a roadblock until that solution is delivered.
That's how I see it, and I think the broader digital asset industry understands the constraints that more traditional finance market participants are facing when trying to come into this decentralized world. There's going to have to be some type of bridge mechanism where we utilize permissioned decentralized exchanges, although there's a little bit of a conundrum in saying that. But I think there is a route where you can have decentralized protocols stand up exchanges in a decentralized fashion, but then make users go through a KYC process, or at least have some type of control on who has access to specific instruments or markets that are offered on a specific DEX. That seemingly almost has to happen before we really get buy-in from traditional finance to engage in these types of protocols.
Yeah, and John, I'm sorry. Go ahead, Alan.
I was going to chime in on John's point. We're seeing that live today, right? Like BlackRock is deploying the BUIDL fund on chain. Coinbase is actually just this week issuing KYC pools for people to provide LP on against base. And there are ways of bringing these traditional assets, these RWAs, these stocks, these bonds, these other instruments in a KYC or sort of limited manner for the people that are accustomed to that type of interface. And so I think we'll see that industry in that area continue to grow. But for the people that do want to remain crypto native and have the know-how and the expertise to actually use these systems in the way in which they're designed or the way in which they intend to kind of plug in more to that permissionless side, we'll see that still kind of have that appetite there as well.
Yeah, and John, we spoke about this. This is a good segue for the question I was going to ask. We spoke about this at Global Alts, right? And when you think about the trajectory of RWAs, the tokenization and so forth, that's really where the pools of liquidity are going to be sourced as the capital markets become more digitized and evolve. So what is the market maker role, and why is it vital in ensuring liquidity for tokens that are listed on DEX?
Okay, so I'm gonna try and split this into two different answers. So when you think about market making on a decentralized exchange, if we're talking about assets that are already liquid, so to speak, like Bitcoin or Ethereum, or the options of call and put options for those assets, or just any token that's trading in the top 200 by market cap, that liquidity provision is important on decentralized exchanges, but I don't think it's the most fascinating part of where market makers are going to come into play. Of course, market making companies are going to find opportunities to provide liquidity in already liquid assets that can be traded on centralized exchanges. But to me, what's fascinating is being able to provide liquidity in tokenized assets that aren't trading on centralized exchanges. And so you think about like the progression of a digital asset, and how does it come into play, so to speak. Traditionally there's been this queue. You get in line to get listed at Binance or to get listed at Coinbase or Kraken or whatnot. But in the past few years, and certainly since Uniswap has come on the scene, we're seeing projects just completely skip that queue for centralized exchange access, and they're listing directly on decentralized venues. That's where I think market makers are going to be able to sharpen their pencil and say, okay, what assets are getting deployed into these DEXs? They're naturally illiquid because there is no centralized component to them yet anyway. And how can we provide a bid offer spread and still manage risk in an acceptable fashion? That's where I think there's going to be a lot of juice for liquidity providers to think about providing value to the ecosystem.
Yeah, Alan, if you could expand upon that point, because I think that's interesting. Let's compare it to TradFi as an example. There's a lot of ETFs that launch, and you're always looking to source liquidity in a very, very competitive space. Do you see that happening in the digital space, where there's a certain segment that will always have a good source of liquidity, and then all the other outliers, or does the digital environment democratize that in any way?
Yeah, I mean, I think if we look at the crypto landscape, it's all about what actually is gaining that liquidity, and then the market makers will flock to what has the interest. And I think things that drive utility long term will continue to sustain and will continue to be the thing that actually pushes forward crypto, because I think it's about looking at the ethos of why we're here, why we're creating these tokens, and what's actually building crypto adoption. So taking a step back, I'm excited about the things that actually promote usage of blockchain technology and ensure that people can participate in decentralized systems and participate in the operation facilitation of the sort of whole vision of Bitcoin, and on top of that, all of the innovations from it. So DEXs are one part of that. And so whenever you have the ability for people to come and trade, we're getting to this point now where a lot of it is PvP, a lot of it is rotations across a lot of different sort of flash in the pans. And so how do we make it so that market makers can come in and provide the right sources of liquidity, sustain things that are long-term, as opposed to coming in and fighting against the retail, fighting against the people that are trying to understand this, become educated, and participate, because oftentimes it looks like the market is kind of selling one thing and then doing something different. So I think it's about understanding the risks associated with market making as well. As someone that has launched a token project, we've seen the ways in which market makers can come in and propose different offers or have different types of schemes or systems that can sort of either take advantage of a nascent team or help a team grow. So it's about bringing in the right partners that want to help the project excel. And I think when you talk about ETFs too, that is definitely something that does conflict or have a competing edge with the liquidity profile for things that are native on chain.
Which is so interesting, John, because it's going to be, I'm curious to see what projects that come on chain are going to be successful and what market makers gravitate to and what they won't. Do you have any insight into that in terms of where they're flocking to now and what future projects do you think will be successful?
I can't help but approach the decentralized conversation from a bit of a biased perspective. And I come into this market really as an options specialist for Bitcoin, Ethereum, Solana, et cetera. And so what I'm really focusing on right now is how are derivatives liquidity going to build out in decentralized exchanges? We're seeing perpetual swap liquidity get solved pretty seamlessly, I would say. But the options market is a little bit of a different animal. And it hasn't had that adoption curve, I would say, that the spot assets or the perpetual swap assets have experienced thus far. And there's a few different functions as to why this is, but at the foundational level, we just need more professional options market makers willing to commit capital to these decentralized venues. It's very capital intensive to make a market in decentralized options. And so that's been a barrier. I'm hopeful that there's going to be some innovation on risk management procedures that will allow for some more capital efficiency when providing liquidity in a decentralized options vault. I don't think we're quite there yet, but we're getting close. And I'm even starting to hear, from the hedge fund community, they're starting to participate in some of these DeFi options vaults as liquidity providers, and that's not even their main focus. So there is growing interest. I'm talking options. I'm also fascinated by the idea that, again, coming from a commodities background, I'll be biased again, but tokenization of commodity markets that are illiquid or not as easily accessible for retail participants in traditional finance, let alone professionals. Like, one that just came up was uranium. And you start to think about as nuclear becomes a conversation again, and as a robust form of energy for us here on Earth, managing risk around that input, uranium, is going to become a big deal. It's not a very well developed market in traditional finance, and it's a perfect opportunity to prove this decentralized exchange architecture to bring in liquidity for a tokenized commodity like uranium, and I could go down the list.
I mean, that's really interesting. And we've seen the traction that it's built with treasuries as an example. I think, Alan, one of the things that we need to exercise too is patience. This is a young asset class. It is competing with TradFi. It doesn't have the typical framework around it yet. And you wouldn't see companies like BlackRock or Coinbase making investments into this if they didn't have a longer term vision, right? And I think there's this recency bias, and we expect immediate results. So I want to ask this question, both you and John, from a near-term perspective and longer term as well, right? Why could 2025 be the crucial year for scaling transparency, deeper market integration?
Yeah. So as you look at sort of the past 15 years of crypto with Bitcoin starting in 2009, there's been so much that we've accomplished, but really we're only just getting started. We have regulation headwinds clearing right now. We have things like the Bitcoin Strategic Reserve, the digital asset stockpile, stablecoin bills, and other types of regulation that are coming down the pipeline that overall create this sort of forward-looking plan and this progress that can easily bring these assets on chain, because it feels like really for the past 10 years, a lot of it has been very circular in terms of all of it existing in one ecosystem and the same players. So how do we grow the pie, bring people in, actually facilitate contracts, facilitate trade, facilitate payments, facilitate actually using these systems that we've designed to go and do things like buying a car with crypto, buying a coffee with crypto, or actually having ways so that we can settle contracts against these decentralized systems and then having that as a means of entry. So I think all of the things that Coinbase, BlackRock, other larger institutions that are looking at this are thinking of it from a practical way. And they're thinking it from how do we actually get more assets to use these systems, because at the end of the day, they're better than the existing infrastructure that we had. As I said earlier, they operate in a 24/7 manner, they're decentralized across the globe, and they're robust. And so we can trust that these systems are going to remain long-term. And it's a matter of how do we improve transparency, improve the trust, the reliability, and ensure that we have more people that can get access to these forms of asset classes.
Right. And John, to wrap up here, when you think about it longer term, it's exciting for me as we're seeing in real time how market infrastructure is evolving and how it's going to, change the landscape for global capital markets. What are your thoughts longer term?
There's something that we talk about in these DeFi conversations called an atomic swap. And it's where I'll use Bitcoin and a stable coin as an example. I wanna buy Bitcoin. There's another seller I want to interact with. Okay, great. I can deposit a stable coin into a smart contract, and that seller can deposit Bitcoin into that smart contract, and then they will automatically swap once both assets are in the smart contract. And I think this is going to be just a fundamental shift in how we think about transferring assets between each other, even in traditional finance. It removes an incredible amount of counterparty risk on these types of deals. And then the other one that I think is just long-term obvious play here is the lending and borrowing markets. And again, I'll use Bitcoin, but we can talk about borrowing dollars against your stock portfolio or whatever traditional asset you want to talk about. But let's say I own Bitcoin and I want to borrow dollars against that asset. I can use the same type of a smart contract, deposit Bitcoin into that contract and pull out stablecoin in this case. And that contract will manage the LTV and the liquidation levels automatically. And I'll have to recollateralize if my underlying asset moves lower in price, and I get collateral return if it moves higher. I think this is where the fundamental mechanics of finance will be impacted, and it'll be long-standing.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.
Yep. Thank you, Jill.